Let me tell you the 4 words I hear right before people lose money. They sound harmless, sensible, even. But once you hear them, it's usually already too late. Everyone is doing it. I've heard those words in bull markets, in bubbles, and right before collapses. I heard them when technology stocks were soaring. I heard them when housing felt unstoppable. I heard them when risk was dressed up as intelligence. And every time, those words marked the moment when thinking stopped and emotion took over. Here's the part most people don't want to admit. Those words don't come from greed. They come from fear. Fear of being left behind. Fear of looking foolish. Fear of missing what looks like an easy win. And fear is a terrible foundation for decisions that are supposed to protect your future. Over the years, I've watched sensible people slowly abandon discipline. Not all at once, gradually. First they observe, then they listen, then they participate just a little. And finally they commit right when the risk is highest and the margin of safety is gone. What makes this especially dangerous is how reasonable it feels at the moment. When prices are rising, when headlines are optimistic, when everyone around you sounds confident, doubt starts to feel irresponsible. Caution starts to look outdated, and patience feels like a mistake. But markets don't reward comfort, they punish it. I've learned that when something becomes widely accepted as a sure thing, the real danger has already arrived. Optimism doesn't appear at the beginning of cycles, it appears near the end. By the time everyone agrees, the upside has usually been consumed, and what remains is risk, quietly compounding beneath the surface. People often ask me how to spot danger. They expect complex formulas or clever indicators. The truth is much simpler and much more uncomfortable. Danger shows up when no one wants to talk about it anymore. When skepticism disappears. When caution is mocked. When people stop asking what could go wrong. That's when I start paying close attention. The crowd has a powerful effect on behavior. It lowers anxiety. It spreads responsibility. If something goes wrong, at least you won't be alone. And that psychological relief is exactly why it's so costly. Because when everyone is responsible, no one feels accountable. I've seen investors justify decisions they would never make in isolation. They didn't increase risk because the facts changed. They increased risk because the environment made recklessness feel normal. And markets have a way of exploiting that weakness with brutal efficiency. What worries me most is when I see this behavior late in life, when people no longer have decades to recover. When a single bad decision doesn't just hurt, it alters retirement, family security, and peace of mind. At that stage, you're not playing a game of optimization. You're playing a game of survival. And survival doesn't care about what everyone else is doing. One of the most important lessons I've learned is this: popularity and safety are opposites. When something is unpopular, expectations are low, and prices often reflect pessimism. When something is popular, expectations are high, and prices reflect hope. Hope is not protection, it's exposure. I'm not saying the crowd is always wrong. I am saying the crowd is never a margin of safety. If you feel pressure to act because others are acting, that's your signal to slow down, not speed up. The market will always offer another opportunity. It will not always offer another chance to recover from a major loss. The 4 most dangerous words in investing don't sound reckless. They sound reassuring. And that's exactly why they've cost people more money than any crisis I've ever seen. I want to go deeper into why those words are so persuasive, because understanding that might save you from making a mistake you can't undo. Human beings are wired to look for signals from others. For most of history, following the group meant survival. Being isolated meant danger. That instinct never left us, it just migrated into markets. And markets are very good at exploiting ancient instincts in modern ways. When you see prices rising and participation increasing, your brain doesn't process it as risk, it processes it as validation. It tells you this many people can't all be wrong. But markets aren't democratic. They don't reward majority votes. They reward correct positioning, and they punish comfort. I've watched investors confuse activity with insight. They mistake movement for progress. When something is going up, Doing nothing feels like negligence. So people act not because the opportunity is good, but because inactivity feels irresponsible. That's a subtle trap, and it's one of the most expensive ones. Early in my career, I learned that good investing doesn't require brilliance. It requires restraint. The ability to say no when others are saying yes. The ability to look wrong for a while without panicking. And the ability to accept that you won't catch every wave and you don't need to. One of the most damaging beliefs I see is the idea that you'll get out in time. People say it casually, confidently, as if timing is a skill that magically appears under pressure. I've never seen that work consistently. When markets turn, they don't ask permission, liquidity disappears, fear accelerates, and exits that looked wide open suddenly feel very small. By the time you realize the crowd is wrong, it's usually too late to leave without damage. That's the cruel part. The same consensus that made you feel safe getting in will make it painful to get out. There's also a misunderstanding about intelligence in markets. People assume that if something is popular, it must be smart. In reality, popularity often signals that the easy thinking has already been done. What's left is shared optimism and shrinking discipline. I've spent my life studying cycles, and here's what I know for sure. Cycles don't end because things are bad. They end because things get too good, too easy, too confident, too unquestioned. Excess builds quietly, then releases violently. When I sense that everyone is doing it, I don't ask myself how much more upside there is. I ask myself who's left to buy. Because once everyone owns something, demand doesn't disappear, but it does weaken. And when demand weakens, prices don't need bad news to fall, they just need reality. Another hard truth is that late-stage success is seductive. When people around you are making money, caution feels outdated. You start to question your own discipline. You wonder if you're being too conservative, too old-fashioned, too fearful. And slowly, you recalibrate your standards not upward in quality, but downward in safety. That's when real risk enters. As you get older, the stakes change. Losses don't just affect numbers on a screen. They affect sleep. They affect relationships. They affect freedom. At that stage, protecting what you've built matters more than proving you're right. I've always believed that the biggest investing errors aren't analytical. They're emotional. They happen when people stop asking hard questions and start seeking reassurance. The crowd is very good at reassurance. It's terrible at protection. If you remember one thing from this part, remember this. Discomfort is often the price of safety. If you're uncomfortable because you're not participating in what everyone else is celebrating, you might be doing exactly the right thing. And if you're comfortable because everyone agrees with you, that's the moment to be most careful. There's another layer to this that people rarely talk about, and it's the one that causes the most regret later on. When everyone is doing it, people stop asking why they're doing it. They already feel justified. The question shifts from, is this a good decision, to how much should I put in? That shift is subtle, but it's dangerous. It means the decision has already been made emotionally, and logic is just being used to decorate it. I've seen this happen with stocks, with real estate, with private deals, with strategies that sound sophisticated but are really just crowded trades in disguise. The language changes. People stop talking about risk and start talking about narratives. They stop asking about the downside and start telling stories about the future. Stories are powerful, they're also expensive. Markets don't move because stories are true. They move because stories are believed. And belief can carry prices far beyond reason. But belief doesn't protect you when reality shows up. Reality doesn't care how compelling the story was. One of the most important habits I developed was learning to separate popularity from value. Something can be widely admired and still be overpriced. Something can be deeply unpopular and still be a great opportunity. Those two things are not opposites, but they are often confused as such. I've noticed that when assets are cheap, people want guarantees. They want certainty before acting. But when assets are expensive, they accept uncertainty without complaint. That reversal should tell you something. Risk hasn't disappeared. It's just been rebranded. Another mistake people make is assuming that because they're aware of herd behavior, they're immune to it. They're not. Neither am I. Awareness helps, but discipline is what matters. The pressure to conform doesn't go away just because you understand it. It gets louder when the crowd is being rewarded. That's when principles matter. Not opinions, not predictions, principles. I've always believed that risk is not what you see, it's what you don't see. It's not volatility on a screen. It's the vulnerability that comes from paying too much, expecting too much, and depending on things going right. When everyone is doing it, expectations are usually stretched, and stretched expectations create fragile outcomes. Even a small disappointment can cause a big reaction because prices were built on perfection. This is where patience becomes an unfair advantage. Not patience in waiting for things to go up, but patience in waiting for things to make sense. That kind of patience is rare because it doesn't feel productive. It feels like standing still while others move ahead. But investing is not a race. It's an endurance test. I've seen people chase what just worked only to spend years recovering from the damage. They weren't foolish, they were human. They wanted confirmation that they were doing the right thing, and the crowd gave it to them generously and confidently. What the crowd never gives you is a warning label. Late in a cycle, the rewards look obvious and the risks look theoretical. Early in a cycle, the risks look obvious and the rewards look theoretical. Most people choose comfort over correctness, and most losses come from that choice. If you're nearing retirement or already there, this matters even more. You don't need excitement. You don't need to prove you're still sharp. You need durability. You need decisions that hold up when conditions change. I've always measured success less by how much I made and more by how little I lost when things went wrong. That mindset isn't popular. It doesn't make headlines. But it's the reason I'm still here, still investing, still calm when others are not. When you hear everyone is doing it, don't hear opportunity, hear a warning. Hear the sound of discipline being tested. And remember that the market doesn't care how many people agree with you. It only cares whether you were prepared. There's a moment in every cycle when discipline feels lonely. That's the moment most people abandon it. I've felt it myself. Watching others celebrate gains while you're sitting on your hands can make you question everything you believe. You start wondering if you're too cautious, too conservative, too slow. You ask yourself if the world has changed and you're the only one who hasn't noticed. That feeling is not a signal to act, it's a test. Over time, I learned that the market doesn't reward urgency, it rewards preparation. And preparation often looks like boredom, restraint, and saying no far more often than saying yes. One of the hardest truths to accept is that missing out is part of doing things right. You will miss rallies. You will watch assets double that you didn't own. You will hear stories at dinner tables and on television that make you feel behind. That discomfort is the price of protection. What matters is not whether you participated in every opportunity. What matters is whether you avoided the ones that could permanently damage you. I've never met someone who failed financially because they skipped a crowded trade. I've met many who failed because they joined one too late. The difference is subtle in the moment and enormous in hindsight. As you move through life, the role of money changes. Early on, it's about growth. Later, it's about stability. And eventually, it's about peace of mind. When everyone is doing it, peace of mind is usually the first thing being traded away. That's why I always return to one central question. What happens if I'm wrong? When an investment only works if everything goes right, it's not an investment. It's a bet. And bets become more dangerous when they're crowded, because the exits are never big enough for everyone at once. I've built my entire approach around the idea that survival comes first. You can't benefit from long-term opportunities if you don't make it through short-term mistakes. Avoiding disaster may not feel heroic, but it's incredibly effective. The crowd doesn't think this way. The crowd thinks in terms of stories, trends, and reassurance. It feels powerful to be aligned with the majority. But markets don't pay you for alignment. They pay you for judgment. And judgment often requires standing apart. If you find yourself saying, everyone is doing it, pause. Ask what you're really responding to. Is it evidence or is it pressure? Is it logic or is it fear of missing out? Those answers matter more than any forecast. I've spent a lifetime watching cycles repeat, and I can tell you this with absolute conviction. The biggest risks are taken when risk is least visible, when confidence is high, when caution feels unnecessary, when agreement feels comforting. That's when discipline matters most. You don't need to be the first. You don't need to be the boldest. You don't need to impress anyone. You need to make decisions you can live with when conditions change, because they always do. If you can resist the urge to follow the crowd, you give yourself something rare: flexibility, the ability to act when others can't, the calm to endure when others panic, and the confidence that comes from knowing you didn't gamble your future on consensus. I've never trusted the crowd to protect me. I've trusted preparation, humility, and patience. Those qualities don't trend. They don't go viral, but they work. So the next time you hear those 4 dangerous words, don't rush to join. Step back, think independently, protect what you've built, because in investing, being alone is often safer than being surrounded. And if you want more of my hard-earned lessons, the ones shaped by cycles, mistakes, and survival, subscribe. I'll keep telling you the truth, even when it's uncomfortable.